everything below 3,000 is cheap, so that is important. Actually, we said that some years ago because we use a very simple chart with the US debt and the Fed's balance sheet. And if you make this analysis, gold was only expensive 2011. The balance sheet has been growing in the last years, maybe coming down a little bit. But at now, actually, gold would only be expensive when it's over 4,000. So 3,000, I think it's not far away.
Hello and welcome back to Soar Financially, where we discuss the macro to understand the micro. My name is Kai Hoffman. I'm the JR Mining guy on Twitter and the CEO of the Soar Financial Group. And of course, your host on this channel. Really appreciate you joining us because we have a returning guest coming back. And back by popular demand, just in the comments you asked, we shouldn't make him a regular. So we are trying. We're doing our best to bring Eric Strand back on more regularly here. He's the founder over at AuAg Funds in Stockholm, Sweden. And he was a keynote speaker at our conference. Sadly, we didn't get a chance to sit down in Frankfurt. It was just a busy event for me personally, and we only managed to get a few interviews in, not as many as I would have hoped personally, but now it's time to catch up. And we had him on in January. I think it was January 16th or 15th. We've chatted. We talked about his outlook for gold and silver, his outlook for 2024, and now that we're, generously speaking, halfway through the year, it's time to go check on those calls, but also look at some of the key points he mentioned during his presentation at Deutsche Goldmesse, some of his 9 nuggets for 2024, he called them, and I'm really looking forward to discussing those with him. Before I switch over to my guest, hit that like and subscribe button and leave a comment, leave a like. It is tremendously appreciated so we can bring guests like Eric on. Getting your feedback means a lot to us, and it helps us make a better program. So without much further ado, Eric, it is good to see you again. Thank you so much for joining me here.
Really nice to be here, Kai. Really nice. Thank you.
Yeah, looking forward to the conversation because it's a really important year. And, maybe this summer is quite important to you personally as well because the Olympics are at the knocking at the door, and Paris Olympics 2024. And you have a bit of a personal connection to it. And I couldn't find it on the website officially, but you've told me, and I found it on online as well. But you're a former Olympian. What does this year mean for you, Eric?
Well, I think, it's always nice to be at the Olympics, but also you learn a lot about yourself when you are practicing so hard. And actually, what is good that you learn to lose because you're always coming back. And I think that's a good property, something good to have when you are in the investment sector, as we are also in the mining sector. Really need to have a strong nerves and strong stomach, and to stay strong when it's tough, or as we say, when it's getting tough, the tough gets going. So that, I think, sports is very good background to stay strong in this business. And I think Olympics is very interesting. With the gold, silver, and bronze, and bronze is like 85% copper. So gold and silver, that's where we invest. So I think it has a lot to do with what we are doing today as well.
Yeah, going for gold was the title of your presentation, and you shared some of those factoids with us because the gold medal is not really gold anymore. How much of it is gold? It's just the coating, pretty much, right?
Yeah, it's like six grams of gold, and the rest is silver, so it still has some good value. And but up until 1912, it was pure gold, so it changed after 1912. So that's also an interesting fact to know. And this Paris Olympics also have the fact where there is one other metal on the medal, and that's iron, a piece from the tour of the Eiffel Tour.
Oh, fantastic! Yeah, that's the middle piece. I think I've seen a photo of it.
Yeah.
Right, that's the middle pieces. Like, we're just curious. Do you know where they took it from? Like, how do you take a piece of iron out of the Eiffel Tower? Is just curious.
Maybe it's not so safe anymore. They took some pieces away from it.
It's not wonky. It's not wonky. No, fantastic. Eric, you gave a great presentation. I told you right on the spot that we need to follow up on a few things. But before we get to some of your nuggets for 2024, we spoke mid-January, so really before the market really took off for gold and silver in particular. Let's set the scene here a little bit, and maybe let's recap the last few months. How have gold and silver developed, and why have they developed the way they have?
Yes, we've made our call end of December for a 20% return in gold. That would mean 2,475. And that looks like a high target, but and especially in January and February. But then later on, and now where we are, we have been already over 2,400. So now it's like almost a careful target 2,475, and even the big banks like JP Morgan came out in March with some more information and saying 2,500. So I think we are on the path of maybe we have to put a new target soon.
Yeah, Citibank called even for $3,000 within the next 6 to 18 months. Curious. Like I interviewed Rob McEwen a while ago, and I actually spoke to him in New York as well just last week. And his $3,000 gold call got so much attention online, and everybody called him, for lack of a better term, a lunatic for making that call, right? And being crazy. Now the banks are using the same dollar amount and calling for $3,000 gold as well. Like, what has changed, Eric? Like, why do we need to think differently about gold now?
Well, first of all, I think 3,000, everything below 3,000 is cheap, so that is important. Actually, we said that some years ago because we use a very simple chart with the US debt and the Fed's balance sheet. And if you make this analysis, gold was only expensive 2011. That's the only time when it was above this on this chart. And now they put on even more debt, and the balance sheet has been growing in the last years, maybe coming down a little bit. But at now, actually, gold would only be expensive when it's over 4,000. So 3,000, I think it's not far away.
But let's talk about maybe that perfect storm, or what happened in March. And I mentioned it in another interview. You go to Toronto, you go to PDAC, the world's largest mining conference. It's always cold, it's always miserable, and right after, gold and the mining stocks drop. Right. This time was the complete opposite. It's, by the way, it's called the dreaded PDAC curse. It's just it's usually a fact that happens. This year, it was completely different. Gold went up. The miners seem to be running decently well. So what has changed?
Well, I don't like to say that it changed because what the Fed does, but unfortunately, that's sometimes the way it is. And I think what they did do, they haven't started lowering rates. We still have that in front of us, but they started with less QT, and that means it's like a stimulus on the economy. And they have also made it easier for the banks to lend more money. So, and the monetary base is growing again. So I think we have a lot of stimuluses out there, and we also see the government running big deficits in the US. And even China wants to do something to get out of their hole. So it's a lot of money coming out again in the system, and the market sees this. And so gold has been strong, and it will be even stronger when the rate cycle turns and the rates will go down again.
Just in the last few days, we've heard a few Fed speeches or Fed members speak, and they're actually turning quite hawkish. Like they're sort of reversing or taking a step back and saying, "Oh, maybe rate hikes are still not off the table." Would you agree with that? And the other, part B of that question is like, what would that do to gold? Because we're hanging in there. We're still trading around. Let me actually get the current price. I had it open just a second ago. So gold is still trading at 23.43, which is really strong still.
Yeah, first of all, I want to say that talk is cheap. So I don't think we should listen too much to it. And actually, I like the periods in the old days when they didn't talk; they just made their job. Now they've been talking so much, so they don't even know what they are saying, I would say. So don't listen to them too much. And of course, why should they say something else than that they can raise the rates? So I think, and I also think that the narrative that they will lower rates when inflation is down is not the right one, even if many believe that. I think the rates will come down when we get some more problems in the system. And we will see, or we are starting to see these problems crack and the system cracking because it's just too much money, too much high costs to pay the debt as it is now. So, we have so much debt and we have rates that are higher than they have been. And that's a big problem for a lot of people, for a lot of companies. And it's only liquidity that is saving the system. So I think they will lower rates, but not because of inflation coming down, but because they have to save the financial system.
Let's just get a little bit more granular on those cracks that you're seeing. I'm just curious because I'll try to keep track of it as well when I open the newspaper in the morning. What should I be pay attention to, Eric?
Well, what I think is interesting is that I only read about layoffs in the big companies. I don't see that they are having much more employees, but the job reports, I mean, there is nobody's unemployed. So that's very, very strange. Where are the jobs really coming from? So I think the statistics are not really correct out there. And also, I think we see a lot in commercial real estate. I think that's maybe where we see the most problems as of now. And that will spread, of course. So I think that somewhere there it starts. You never know where it starts, but that's, I think, is a place. I mean, you see a lot of real estate selling for very low prices in the US, and so they have a lot of problems there.
Yeah, I personally was expecting that maybe the Evergrande crisis in China was maybe a bit of a trigger, but it didn't seem to have spiraled out of control because there are a lot of international debt holders in that company, and I think that was a $300 billion wipeout. Quite literally.
Yeah, and exactly, and one day it will be, but we still see. I mean, liquidity is saving the system. So, and I think, of course, they will do anything to save it, but one day it will be just too much to handle for the system. And then, of course, the central banks will be there to save the system. So they will be the white knights again, even if it was a problem that they may yourself. They were the ones who created it by going too low and then too high and then too low and so on. So I think they should be more stable. They should maybe be not lower the rates so much as they did. They shouldn't hike their rates as much as they do. So they're a little bit behind the curve, I would say.
I got a little bit ahead of myself mentioning the perfect storm because I threw all factors that I consider into one pot, really, meaning geopolitical, maybe technical, like just chart pattern for gold as well, but also macro reasons. And I don't know, based on European, like what is the main driver behind the gold price right now? Would you say it's geopolitical? Is it the macro front? Is it just technically driven? Like what's the main driver for you, Eric?
Well, number one is for me is the monetary inflation going on there. I mean, and you see the U.S. Deficits at 6% last year and maybe 8% now for the largest economy in the world. And then, of course, you see the deglobalization. We see central banks buying so much gold since 2010. 2022 was a record. 23 was almost the same as 22. And the first quarter of 24 is the highest first quarter ever. So they are buying a lot. Actually, retail ETF investors have been selling, and for me that's still a positive because that means that the buying power is still there for gold to go higher. So I think maybe confiscating Russian assets, right or wrong, the problem is that you create an uncertainty, and we see maybe China, if they want to do something with Taiwan, you never know. Why should they hold US assets and risk whatever US would do then? So I see a lot of BRICS countries very interested in having more gold. So that's a big buyer. The ETF buyers have not been there, and as I said, that's a good one because they can come in and buy even more and follow the price. So that looks really, really good. And then also we have this very new phenomena that the big ones or half big companies, they don't want to buy explorers. They just buy already producing companies, which means things are happening in the sector with the mining companies, but there are no new production when they buy an already producing company. So no extra gold or silver will come in the market in the coming years, which means that will take the prices higher.
Especially like we were seeing an example today, and we're recording this on Wednesday, May 29th. Today's deadline day for the fourth offer from BHP for Anglo. So talking about just not replacing or renewing or adding new production. It's just we're buying cash flow. We're not buying anything new. We're not adding anything new to the market, right? And that's what we're seeing in the copper space right now. Without going too far off topic here.
I think that's also in the gold mining. I mean, the gold miners have been buying other rather big gold miners, so there is no new gold, and this may be wrong, but I think this is what will happen in the first coming years, 2-3 years. So it will take some time before the money goes down to the really small companies, I think.
No, fantastic. Let's put a bow around that because I want to throw in silver into the equation here now as well, Eric. And you made a silver call because you said, well, if gold goes to 24.75, that's your 20% target. Then silver should go to 35 because you're looking at a silver to gold ratio of 70 to 1. Where are we on that forecast? How is it developing?
Well, we're getting really close to 35 already, so I have to raise that target as well, I guess. That's, I mean, the reason is we have had the gold to silver ratio at the 85, 90 to 1 for a long time now, even above that. And we think it's time when the secular bull market starts for precious metals that we think started on 29th of February here, the long one. And 71 to 1 is our first target, and we think it will go down much lower. Normally it ends a bull market for precious metals maybe at 30 to 1. We think we will go there, but even lower maybe this time. So there's a lot of potential in silver. I mean, 16 to 1 is the natural occurrence in Earth. So, and this time actually we think as silver is so crucial in the electrification and high-tech world, and totally, it's, I mean, indispensable in the industry. We think that it can go to 10 to 1 or even single digits. So, and 10 to 1 or 30 to 1 and a 3,000 gold price. I mean, already at 30 to 1, that's a $100 silver price. So a lot of room for silver to move.
I was going to say, like, let's elaborate on the part like why silver should move. We had Chen Lin on earlier this week, and he dove into like the solar panel specifics and gave us some market data there as well. You believe that the silver demand is driven by the industry mostly, meaning the EVs, the electrification of the world?
Well, first of all, I think, I mean, silver is so amazing because it's the only metal. I mean, we love all metals, but silver is like the only metal that where you have both investors and the industry competing for the silver. I mean, in gold, 10% is for high tech, but 90% is for investing or jewelry. And in copper, it's only industry. So silver has a very unique position. And then silver is the metal that leads electricity and heat better than anything else. And so you cannot do actually anything without silver. It's the second most used commodity of the world after oil. And but what is interesting, you use so little. I mean, in a normal car, you use 20 grams of silver, but in an EV, you need 35, 40 grams of silver. So it's not much more, but you need it, and you cannot produce the car without the silver. So it's not about solar panels. You cannot do anything without the silver, but still it's so little. So even if the price goes up 100%, 200%, 300%, 400%, it won't change the price of the end product or the car. So and when we start to get a competition for industrial silver, I mean, prices will just fly. On the investor side, I mean, you can put on coins and so on, you put on premiums, and that makes some people start to buy less maybe, but the industry, they can't produce the car without the silver. And when they start to compete, when it starts, it will just fly and it will move really, really fast. And it is already too cheap because of what has happened on the Comex, and it's so bad with the manipulation that has been going on. But on the other hand, for people coming into the investments scene here now, that's a special opportunity, one-time opportunity that the prices are so low and pushed down, and they are much lower than they should be. But again, it's an opportunity today. If you haven't already invested, it's an opportunity to get that extra returns.
I just looked at the gold silver ratio, and personally, like, I haven't paid too close attention to it, but we're down to almost 74 or 74 and a half right now, which is quite impressive. And the reason I sort of missed it, it was a really busy May for me, but it only started in early May. Like, we were trending around that 85 to 87 level, maybe to a degree 90 exchange ratio for the longest time, and then it broke down. Did you make out a single trigger for that, or is that just the market is catching up to what gold has been doing?
No, I think everything is talking for silver. I mean, the only problem we have is the Comex positions, because some short players have been going short all of this. So they have been, I mean, they have unrealized losses of above 20 billion US dollars. and they are fighting with everything they have to get the prices down, and they have a problem to get the prices down now, and so they can buy back their shorts. And they have been doubling down on this, so they are even more short. So this is very interesting. With short term, this is very interesting. What will happen to the price? Because if they can get the price down, if they can get the speculative long ones to sell, get the price a bit more down, and slowly buying back their shorts, we may see that. We have seen that before. But on the other hand, silver still goes up. I mean, it went up on Monday, it went up on Tuesday, even if they try to get it down. And if they don't succeed, and I don't think they have the biggest names with them now, like before, like JP Morgan. So it's small, big players, but still smaller than the big, really big ones. And that's their soft spot now. And if they have to give up and start to buy back, I mean, that will make prices fly. So it's a little bit of a binary situation right now in short term, if they will succeed to get the prices down a little bit, or if it will just fly from here. So it's very difficult to be out of the market, but you have to be able to survive a short drawdown or correction from here as well.
No, fantastic. Excellent insights here. I just want to share this graph with you here. Oh, and let me get that symbol search out because I prepared a bit of a graphic. I hope you can see it, Eric. But it's gold versus the GDX and GDXJ. I'm not sure if you like. I'm just trying to make a point. Like gold has moved about 15.5% year to date here. The GDX about 19% and the GDXJ 23%. You would think in an environment like this, and maybe that's sentiment speaking, you would think that the miners and the stocks would move maybe a bit more violently, but they really haven't. Yes, they're playing catch up still to the gold price, it feels like, but it's not drastic outperformance like you would expect, like the 15.5 to the 19 as for that risk premium or for the increased risk, you might as well just might have bought the gold. Like, why bother, Eric? And why are the miners lagging behind?
Well, I don't think they are. I mean, our silver bullet fund has performed really, really well, and I mean, if it's 40% or whatever, so I mean, you see the right side there. It has done a lot lately. So on this year, so really, really strong performance from our miners. But of course, they are focused on silver. So there are good returns, and I think they do outperform the commodity itself, and we will see more of that. For sure.
Now, is it just
because there has been? I think it's because I think the space is so cleaned out. So whatever comes in are strong hands, very interested investors. So it's a good, clean situation. People who wanted to invest in the commodity itself, gold or silver, they are there. The people who want to invest in miners, they are here now. So I mean, we have had these for 10 or 15 years. There may be people who were invested in mining, but they wanted the gold. But now they can invest in gold ETCs and ETFs. So they have done that. So we have a clean out, and I think that's a very, very good spot to enter the mining sector.
Yeah, Monday I was in New York, sitting in my hotel room in the morning, preparing my presentation for a conference I was attending, and I was watching Bloomberg surveillance in the morning, and the only talk was about gold and copper. It was absolutely crazy. There's absolute euphoria, and then in the afternoon, I caught a glimpse at I think the segment was called ETF IQ or something like that. And let me see if I still have it open. Yeah, I do. I want to share that real quick. It is inflows into the gold ETFs. Let's make that a little bigger so people can see it, and let's accept all the cookies, of course. But my point is, like, GLD saw a weekly inflow of $510 million, and the GLDM, which is a smaller portion of it, another almost $200 million. So massive inflows into the ETFs in the US primarily. So is that the beginning of a new trend, Eric? Is like, have the floodgates opened now?
I think this is what I said before. This is the opportunity as well for the price, because they have been sellers in these ETFs for a long time when the central banks have been buying, and now they start to catch race, and so there's a lot of money coming back into the ETFs, and of course that will take prices higher. So it's a good spot for the price, because if we had had inflows for a long time, I mean, there wouldn't be so many new investors or new money coming back into the ETF. So again, it's a good thing that they haven't been big buyers for a long time. Now it's starting. Yes.
No. Well, I think that's what's prepping up the gold price right now, and keeping it where it is, I believe. So, no, that's good to see. Eric, we need to talk about your presentation at Frankfurt now.
Yeah, sure.
Long intro to it, and we need to talk about the nine nuggets for 2024, and maybe we'll pick 2 or 3 out of them to discuss. I'm going to share them on the screen here.
Yep.
All of them. We're going to give some of them away because one of my favorite one is actually the first one that we'd like to discuss, and I'm curious if that's possible. A couple of them we already discussed, like the last one, gold to 4,000, gold silver ratio. But let's talk about from price takers to price makers. It reminds me a bit of the OPEC cartel, and where we control production to regulate the price of gold. How realistic is that nugget for 2024, Eric? And what is your thought process behind that one?
Yeah, the thought process is that I really realized that the miners are a bit, I mean, we're like too weak with the price, and comparing it with Apple making the iPhones, and they are price makers, and that's such a big power because they set the price, and people have to buy the phone or want to buy the phone. And in the metal mining industry, it's just the opposite. They are just price takers, and somehow this has to change, that the miners get act a little bit different. I don't know how they should solve it, but they should start to really think about this, how to become price makers instead. Of course, in a market where you have, I mean, if it's a physical shortage, that starts to get interesting, and we can see that in silver and copper. In gold, it's maybe harder to get a physical shortage, as there is a lot of gold still in everybody's hands. So that's where I think they have the biggest possibilities to just become price makers. So of course, one possibility would be that instead of holding too much cash, if they don't want to spend it on new projects or buy up developers, I think that would come in the end. The really small companies will have fantastic returns. But on the other hand, I think it may take a little bit more time this time, because the miners, as I said, the larger ones, they rather buy producing mines at the moment. But in some years that would change as well, and then that would be the time for the really small companies, I think. But the big ones, I mean, if they hoard cash, I mean, they could hoard it in gold if they believe in what they are digging. They could hoard gold instead of and not selling it to the market for any price. So I think that would be a possibility. And I mean, we see some companies doing this, keeping their silver tight instead of holding cash.
Yeah, that's the second nugget you've shared here with us, Eric. It's the excess cash. If not buying assets, then buy some gold and silver. You know, the question is as well as like maybe on the first nugget, real quick. I'm going to come back to the second in a second. Do you think it would shift production north to south, meaning from high cost countries down to I don't know, Africa, or lower cost, lower capital intensive countries? Like, would that destroy the marketplace?
No, I think, I mean, now it's very interesting. I mean, jurisdiction anyway has come up much higher on the list. So it's really interesting where to mine, what to mine, how to mine. And don't forget, I think this is what is really interesting now, because the costs went up. The margin expansion from now on for the miners is explosive. So I think that's why we see the miners go up so much, and have already started since March, April. Because sometimes it's good if you have a miner with high cost. You always think you want to have a miner with low cost, but in a strong price and the price going up, I think you will have even more leverage on the miners with high cost. So it's not always the best to have miners with the low cost. It's safer, but it's not always the best for in the investments returns.
Yeah, it's that optionality cost, I think, as well, and the margins it can expand quicker, meaning the share price can explode rather more violently.
And I think that happens on all companies at the moment, because costs went up for all companies. That was a drag. That's why the performance for the miners dragged after the commodity price. So now the cost, okay, they are there, they are stable, and now when gold continues to go up, the margin expansion is much more explosive, and that's very, very interesting coming. And I think that's what we will see in the returns as well.
Let's talk about the second nugget. Excess cash, they should buy some gold and gold and silver, maybe, or even hold back production. Like how realistic is that? Like, let's talk about the financial position of those companies, but also then the market impact. Like, I know a couple of the silver companies have tried to do that a year and a half ago, to sort of help suppress the market a little bit and push silver prices higher. But how realistic is that maybe for gold? It's a much different market, isn't it?
Yeah, what I do see maybe with gold is that, I mean, there has to be some even more pressures on refiners that the gold is sourced in the correct way. That where is the gold coming from, so that the real good miners can have even another price than gold that is coming, that is illegal gold or whatever it is. So some structural changes there, I think, is the beginning maybe.
Okay, no, I appreciate you clarifying that, Eric. And really interesting nuggets. I have one last one I'm going to follow up with you here. Is the 2 times leverage and the timing, is especially for European investors, because I'm based in Europe. But what's my special advantage here, Eric? It's that third one from the bottom.
Yeah. I love this one, and it's easy and complicated the same way. And I like to make a small example, and that is if we have a return for gold at 20% in US dollars, and let's say we have a 2 times leverage for miners. That's just an example. I mean, it can be 1.5, it can be 3, but 2 times. So that would mean a 40% return, but still it's a 2-to-1 return for the US investor. Let's say that the US dollar will lose to the euro when the Fed starts to lower rates, and let's say the dollar loses 10%. Then investing in gold for a European investor, I mean, gold returns 20% in US dollars, but you will lose the 10% on the FX. So you will sit with a 10% return, still not bad, but it's 10% and not 20% in Europe, if you count it in your euros. What happens with the miners is that the leverage they have on the price, it happens before this FX effect. That means the gold was 20% in US, the miners 40%. Okay, so we get 40%, but then we lose the 10% again on the FX. So we have a 30% return, and of course that's not bad as well. But the interesting thing is the factor for the European investor is suddenly 3-to-1, 30% vs 10%, and this happens when the dollar goes down. And the opposite effect is when the dollar goes up. But the dollar normally goes up when the rate hike cycle starts going up, and the Fed are normally always the first or the strongest player. And we saw that the dollar went up when they started to raise rates. Normally the Fed, they may wait a little bit, but when they start to lower rates, they are also the most aggressive, doing things more powerful. And we can also see that the dollar may lose some of the premium it has as a world reserve currency because of what is happening in the world. So we see a case, it hasn't happened really yet, but that the dollar will come down and the euro will be stronger. So at that point, it's even more interesting to invest in gold or silver miners than in the commodity. In the beginning of the rate hike cycle, it was the opposite. Now is the time. This doesn't change for a US investor. I mean, they are in dollar, it's already there, it's 2-to-1, the leverage, and nothing happens. But for a European investor, time is for the miners now to invest in,
especially since the ECB might cut in June, right? Which I think might actually make the euro a bit stronger. So there's some additional leverage because
I don't know if it will make it stronger, but I think the market will, in the end, the premium of the dollar will come down, and that's the thing. And then which central banks that lower rates first or not, that's their own game. And if they do it to have a soft currency so they can export, I mean, they think about so many things, whatever. And I think the dollar has had its strength. Of course, it has some strength. It's the big currency. it's the least bad one in the classroom, but still the premium is losing its power of the dollar, and also the rate cycle, it will come down, and the dollar will lose something. I mean, not very much, but maybe at least 10%. And that would be, so that's why it's so interesting for European investors investing in the miners if you're going for the returns, and then do it now.
No, perfect. Time is now, Eric. Excellent discussion on gold and silver, but I want to use the last few minutes here, maybe talk about other trends you're witnessing right now. Is there anything else, any other metal or any other global trend that you're following that is worth paying attention to?
Yeah, I think, I mean, we have been speaking a lot about the green transformation or transition. That hasn't been so popular lately, but what is there is the electrification, and nobody's arguing about that. And we see even the AI mania will need so much copper and silver to run these computer centers. So again, it's the metals that lead electricity, and I say leading, and that is copper and silver. We have the battery metals, but they have been in troubles because you see EV cells going down or not going up anymore, and so on. And you can have a new technique for new batteries and so on. So there's a lot of competition, a lot of things happening. Prices can go down a lot. They can go up a lot, but it's very difficult to handle. So leading electricity, electrification is coming, AI is coming. We need more copper and silver because these are the two metals that are leading electricity the best. And of course, silver is the best, but it's maybe too expensive to use copper. So I think copper is really, really hot as well.
Okay, you just reminded me of a question I wanted to ask you before as well. You sort of answered it, but I just want to drive the point home maybe and just get it clarified. Is gold at $2,400 too expensive, and is silver too expensive at $32? And I do mean optically, like not maybe fundamentally, but optically, especially for the retail investor. When you buy a coin of silver for $32, is that too expensive, or what do you think? Like, how do you put that into perspective?
Well, I think it's very, very cheap actually. So the only thing that can take prices down that is a bit difficult is the situation at the Comex. So we are far away from silver having a fair price, correct price. So it's still a good opportunity. I also like, maybe we said copper, but I think, I mean, uranium nuclear has been a bit soft lately, but I think that will come back as well. So that's also an interesting metal.
No, fantastic. Eric, when are you going to update your forecast report, and when do you have to adjust, and when will you adjust your calls for the rest of the year?
Well, actually, we don't want to do forecasts. I mean, we are long only, fully invested all the time. We don't time the market. I mean, we would like to have a sound economical system, but we know we don't have. Money printing will be there, monetary inflation been there. The US dollar has lost 98% of its value. It will lose another 98% of its value in the coming 50 years again. So because that's the way politics is working, it's much easier to print the money than to do a good sound financial system. We have to understand that, and accepting that maybe that's the way it is, and then that's why we need gold and silver in our investment portfolio. So forecasting, it all depends on how much money and how fast they print it, and how much problem they think they have to solve with that liquidity. So that's the way. I mean, gold is gold, silver is silver, and it's actually the currencies that are losing value because we just have more and more of them out there.
Oh, fantastic. Eric, where can we find more of your work?
Good.
No, where can we find more of your work? Where can we follow you?
Sorry. Of course, you have to visit our webpage, auagfunds.com. There, of course, you can subscribe to our monthly letters. They are rather short. We try to have some different topics, of course, for free. And you can also look at our funds as well. But go on our webpage. We are very open. We are very transparent, having all our holdings on the webpage on our funds. And we think that is the future for fund management, to have a very clear investment philosophy.
Fantastic, Eric. Really, really appreciate your time. It's always good to see you, my friend, and can't wait to have you back, and maybe in September, October, and see how the rest of the year is going, and how your calls are playing out, and maybe you've put out an update forecast in the meantime. So we'll see about that. Fantastic, Eric. Thank you so much, and everybody else, thank you so much for tuning in. Tremendously appreciate you watching us here, Soar Financially, where we discuss the macro to understand the micro. Leave a comment, leave a like. Do we ask the right questions? Does this conversation help you understand the markets better? It's really important for us to educate, not just on the macro side, but also on the micro. And for us, micro means the commodities, gold, silver in particular, of course. We look at copper, some of the other metals, but also the mining stocks. So let us know, and we tremendously appreciate your feedback. So thank you so much for tuning in. We've got lots more coming up here on Soar Financially. Thank you so much for tuning in. We'll be back with more.